Imagine two people, same city, same year. One of them opens his brokerage app every morning, watches his portfolio climb, and genuinely feels like the economy is working. The other one goes to the grocery store, does the math in her head, puts something back on the shelf, and wonders what the hell is going on. Here's the thing. Both of them are right, and that contradiction, that one economy somehow producing two completely different lived realities at the same time, is exactly what we need to talk about. Let's start with the number everyone keeps celebrating. The S&P 500, America's most watched stock index, has more than doubled since 2020. Trillion-dollar companies, record earnings seasons, financial media running headlines like markets hit all-time highs so often it stopped feeling like news. On paper, wealth is being created constantly, visibly, measurably. So why does a Gallup poll from 2024 show that nearly 55% of Americans describe their personal financial situation as only fair or poor? Why is consumer sentiment, by some measures, hovering near levels we last saw during recessions? The market is up. People feel down. There has to be a reason. There is. And it's not one thing. It's a system. Here's the first piece of the puzzle, and it's the one most financial media conveniently skips. Stock market wealth is not evenly distributed. Not even close. The top 10% of Americans by wealth own approximately 93% of all stocks. The bottom 50%, they own less than 1%. So when the market goes up 25% in a year, that gain is almost entirely absorbed by people who were already wealthy. Everyone else watches the headline, maybe feels vaguely optimistic, and then goes back to their actual financial life, which is governed not by asset prices, but by wages, rent, grocery bills, and credit card interest rates. The market going up doesn't automatically make your life better if you don't have meaningful exposure to the market. It makes someone else's life better. You just get to read about it. Now layer in the second problem. Inflation did something subtle and devastating that the raw numbers don't fully capture. Between 2020 and 2024, cumulative inflation in the U.S. ran somewhere between 20 and 23%, depending on the category. Shelter costs, meaning rent and home prices, ran considerably higher. Food at home up significantly. Wages did rise, but for most workers, especially in the bottom half of the income distribution, wage growth barely kept pace. And it definitely didn't compensate for the permanent price level reset that happened. Here's the uncomfortable math. A salary increase of 5% sounds great until you realize that eggs cost 40% more than they did 3 years ago, and your rent has gone up 30%. You earned more. You have less purchasing power. You feel poorer because, in real terms, you are. The market hit new highs during all of this. The headlines celebrated. Your bank account told a different story. There's a third layer, and this one is particularly cruel in its timing. The pandemic era created what economists called a wealth effect, a surge in asset prices that made people with assets feel richer, spend more, and push demand higher. Housing values exploded. Stocks surged. Crypto went vertical, but then interest rates rose sharply, quickly to fight the inflation that all that stimulus helped create. And here's where it gets ironic. Higher rates are great if you have savings. A 5% return on a money market account sounds fine, but higher rates also mean higher mortgage rates, higher car loan rates, higher credit card APRs. The median American isn't parking money in T-bills. They're trying to finance a car at 8% or carry a credit card balance at 24%. Higher rates in their lived experience means debt gets more expensive, not that their savings compound faster. The same policy that cooled inflation also made borrowing, which is how most middle-class people make major purchases, significantly more painful. The stock market, meanwhile, largely shrugged and kept climbing. Zoom out further, and you start to see the structural shape of what's happening. We have an economy that is increasingly efficient at generating financial returns and increasingly inefficient at translating those returns into broad-based prosperity. Corporate profit margins are historically high. Worker compensation as a share of GDP has been trending downward for decades. The productivity gains of the last 30 years have accrued overwhelmingly to capital owners, people who own things, rather than to labor, people who do things. The stock market is, in many ways, a measure of how well capital is doing. It is not a measure of how well people are doing. Those two things used to be more correlated. They are less so now. So here is where we land, and it's not a comfortable place. The stock market is not lying. The economic economic pain isn't imaginary either. They coexist because we've built a system where financial prosperity and human prosperity have become partially decoupled, where rising markets can be a real and accurate signal of wealth creation while simultaneously meaning almost nothing to the majority of people experiencing the economy through their wages, their rents, their monthly bills. The question worth sitting with isn't why does the market keep going up? Markets follow incentives. They do what they're designed to do. The real question is who exactly is the economy designed for? And why, in 2025, with markets near all-time highs, does the honest answer to that question still make so many people uncomfortable?